Hey guys, Adam from BizNexus. We've got another AI Roundup chat for you today. This one's based on a recent article from the New York Law Journal exploring the current state of the middle market. The article was put together by Andrew Lacano and Moshe Berliner just this week on the 28th. And you can find their info in the show notes if you'd like to reach out directly and connect. Based on the article, the AI co-hosts are going to break down a conversation about the current state of lower middle market deal terms and deal term trends, including insights on reps and warranty insurance, no survival deals and survival periods, indemnity caps and baskets, fraud carve-outs and definition, escrow amounts and periods, and tons of other relevant deal term insights that Andrew and Moshe have laid out in their article, which again you can find in the show notes if you want to read that article in its entirety. Word of caution, just like all of our other roundups, this is just a conversation. It happens to be done with AI based on a source article, but it is not investment advice. It's not even humans talking to humans, so do your own homework. Don't make any investment decisions based on this. Don't change any contracts based on this. I'd advise you to reach out to Andrew and Moshe directly if you have any questions about what they're talking about, or if you just want to dive deeper. But we are not in the business of offering investment advice. We're just here to have some interesting conversations. If you're not familiar with who we are with BizNexus, please do be sure to check us out at biznexus.com. We're an M&A marketplace for business acquisition. And for do-it-yourselfers, we have Marketplace with thousands of acquisition opportunities. That's updated daily. We have our community where you can network with people like Andrew and Moshe. You can find people to be on your deal team. You can search by keyword or get matched by AI. And then we also have an enterprise platform called OmniSource, which we use for our private equity clients, our family office clients, our corporate acquirer clients, repeat acquirers, and it combines all of your on-market, off-market targets for your mandate into one seamless experience. If you're interested at all, check out biznexus.com or omnisource.ai, schedule a demo, and we're happy to run you through it. So that's it for the promotion. Let's get into what the AI put together for the conversation about deal terms. Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome back, listener. Today, we're going to dive into middle market mergers and acquisitions.
M&A.
M&A.
Yeah.
You got it.
For those in the know.
Right. We found this really cool article on law.com that analyzes some pretty important trends.
Yeah.
And it's all based on this new Seafarth Shaw deal term survey.
Really interesting stuff.
Yeah. So they looked at 130 M&A agreements.
Wow.
To give us a look at how deals are being structured.
Particularly in the lower middle market.
Yeah, exactly. So what's been fascinating to me is how this whole middle market,
especially that lower middle market.
yeah, how they're dealing with this crazy economic climate.
Right, because we're talking high interest rates.
Oh, yeah.
Inflation that just won't quit.
And all that global uncertainty.
Exactly. It all plays a huge role in how these deals actually get done.
Absolutely. So let's break it down a little. The article talks about how 2023 was a tough year for M&A.
Definitely a roller coaster.
Yeah. Deal volume dipped, buyers got skittish.
Everyone was holding their breath.
But 2024
seems to be whispering, come back.
Okay, so what's driving that shift?
Yeah.
Especially for the smaller businesses out there.
I think one of the biggest factors is how private equity has shifted its strategy.
Those are the big players, right?
They're always on the hunt for that next big deal. But in 2023, with all the uncertainty, they had to get smart.
Yeah.
So instead of chasing those massive headline-grabbing acquisitions,
right,
they turned their attention to the lower middle market.
So instead of going for the whale,
they're going for a school of fish.
Right. Snagging those smaller, more strategic deals.
Exactly. These smaller add-on acquisitions are less risky, less costly, and they let private equity firms strengthen their existing portfolios.
Oh, that makes sense.
Think of it this way. You have a company in your portfolio that makes, let's say, high-end bicycles.
Okay.
Now, instead of buying another bike company, you buy a smaller company that makes bike helmets.
I see.
Or those high-tech bike lights.
Suddenly you're a one-stop shop.
Exactly. You've created this synergy and boosted the value of your original bike company.
I love that analogy. But what about exits? The article mentions that they're still kind of slow.
Yeah, private equity exits aren't exactly breaking records right now.
Is that impacting the lower middle market too?
To some extent, yes. But there's a growing buzz about late 2024 and into 2025.
okay.
Remember, those limited partners who put money in private equity funds, they want to see returns.
Yeah, they want their investments to pay off.
Exactly, and that pressure is going to push more activity forward.
Especially in the lower middle market, I bet.
Absolutely, where valuations are more attractive.
So it's like a pressure cooker. The heat is on.
Yeah, something's got to give.
Exactly. And it's not just pressure.
No, there are other factors too.
Like what?
Well, we're starting to see EBITDA multiples stabilize after being all over the place.
Wait, what's EBITDA again?
Good question. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right.
It's a way to measure a company's core profitability.
Got it.
And because those multiples are stabilizing, valuations are becoming more predictable.
Which makes buyers more comfortable.
Exactly.
Okay, so we've got this cautious optimism in the market.
Right.
And private equity is getting strategic, focusing on the lower middle market.
Smart move.
How's that impacting the deal terms themselves?
Well, one of the most interesting trends is in representation and warranty insurance.
RWI.
Yep, RWI for short.
Okay. Sounds a little technical, but it sounds important.
Oh, it's a game changer, especially in the lower middle market.
Can you break it down for us? Like RWI for dummies.
Sure. Think of RWI as a safety net for buyers in these M&A deals.
Okay.
It protects the buyer if the seller makes promises, what we call representations and warranties,
Got it.
that turn out to be false.
So like if the seller says the business is super profitable,
Yeah.
but then it turns out they weren't totally honest.
Exactly. RWI could help cover the buyer's losses.
So the buyer's not stuck holding the bag.
Exactly.
That's a powerful tool.
It is. Our survey showed that RWI was used in 57% of the deals they looked at. That's a lot.
Yeah.
Buyers are getting more savvy about managing risk.
Especially in the lower middle market,
Absolutely.
where it can be hard to get all the information you need.
Right.
But here's the interesting part. That lower deal volume we talked about,
Mm-hmm.
it created a lot of competition among RWI insurers.
Oh, yeah. They're all fighting for business.
So does that mean?
Buyers are getting better deals on RWI. You bet.
Nice.
Broader coverage, lower costs, and fewer loopholes for sellers.
Score one for the buyers.
Absolutely.
But how does this RWI impact the overall deal structure?
You know, that's a fantastic question.
I mean, if you have this RWI safety net,
Right.
does it change how other parts of the deal are negotiated?
Absolutely. And that's particularly important in the lower middle market where those details really matter.
I bet.
The presence of RWI can affect everything, like indemnity escrow amounts
Okay.
and those tricky things called indemnity caps, which we can definitely dive into later.
Okay, let's hold that thought.
Sounds good. Yeah. But first, let's look at another trend the survey found.
Yeah.
A shift in how liability is handled in private company deals.
Oh, interesting. Why is that so important for the lower middle market?
Well, a lot of those businesses are privately held, right?
Right.
So traditionally, public companies have used a no survival structure
For what?
for representations and warranties.
Remind me what those are again.
It's basically all those promises the seller makes about the business being in great shape.
Okay.
With no survival, those promises basically disappear at closing.
Oh, wow. So the buyer's kind of out of luck if something goes wrong later.
Pretty much. But private companies, they've usually used indemnities.
Indemnity.
Yeah, it's like a backup plan to protect buyers after the deal is done.
Makes sense.
So two different approaches, public versus private.
Right. But the article talked about a shift in the private market, right?
Exactly. For a while, we saw private deals moving towards the no survival model.
Especially when there was RWI involved.
Yeah, exactly. It was like buyers were saying, hey, we've got this insurance. We don't need indemnities.
Okay.
But the CFARTH data shows a reversal of that trend.
Really?
Now, only 25% of RWI deals use no survival.
Huh. So buyers are getting more protection even with RWI.
Seems like it. It means they're getting some power back in negotiations.
Okay.
They're realizing that even with RWI, it's good to have those indemnities as a backup.
So it's like having a seatbelt, A&D, and airbag.
Exactly. You want all the protection you can get, right? Especially in the lower middle market where relationships and reputations really matter.
That's a good point.
What's driving this shift? Well, I think it's a few things.
Like what?
Buyers are understanding the limits of RWI better. And sellers are realizing they can't just rely on insurance to avoid all liability.
It's like a constant back and forth.
Exactly. Buyers and sellers always trying to get the best terms.
And this liability shift is just part of that game.
Right. It's this dynamic between the two sides that makes this market so interesting.
Especially in the lower middle market.
Absolutely. Where everything can be a bit more complex.
All right, listener, we're about to get into some of those nitty-gritty deal terms,
The fun stuff.
like indemnity caps and basket. But before we do, Let's take a second and think about what this all means for you.
That's a great point. This isn't just about financial jargon.
Right.
It's about understanding how businesses are bought and sold.
Which affects all of us.
Absolutely. It impacts things like innovation, investment, and even job creation.
So whether you're an entrepreneur, an investor, or just someone who likes to keep up with the business world.
This stuff matters.
It does. And
Yeah.
what I find really interesting is this tension between economic uncertainty
Right.
and signs of a rebound, especially in the lower middle market.
Yeah, it's a dynamic situation for sure.
Absolutely. So are you ready to unpack those baskets and caps?
Let's do it. They might sound like something you'd find at a picnic.
Right.
But trust me, they're super important in M&A deals.
Okay, I'm all ears.
Think of indemnity baskets like a deductible on your car insurance. Imagine you back into a pole and dent your bumper.
Been there.
Do you file a claim right away?
Probably not. I've got that deductible to worry about.
Exactly. Indemnity baskets are kind of the same.
So the buyer has to cover some losses before going after the seller.
Exactly. It helps weed out those smaller claims.
And it keeps everyone focused on the big stuff.
Right. And that's especially important in the lower middle market, where those small claims can really add up.
So there are different types of baskets, right?
Yeah, there are tipping baskets and true deductibles.
What's the difference?
Well, with a tipping basket, once the losses go over a certain amount, the buyer can claim everything.
Not just the amount above the basket.
Exactly. It's like a dam breaking. Once it hits a certain point, everything flows through.
Interesting. So with a true deductible.
The buyer can only claim what's over the deductible, just like car insurance.
I see.
The survey found a shift towards tipping baskets, especially in deals without RWI.
So buyers are getting a little more leverage.
It seems that way.
They want more coverage, even for smaller issues.
Exactly. And this is a trend to keep an eye on, especially in the lower middle market.
Definitely. Okay, so what about those indemnity caps?
Yes. The indemnity caps, those are like the upper limit on what the seller has to pay out.
Even if things go really wrong.
Exactly. Almost all deals have them, but the amount can be different depending on whether there's RWI or not.
So RWI affects the caps too.
Absolutely. Without RWI, the caps are usually higher, maybe 10% of the purchase price.
But with RWI?
They can be much lower, sometimes even less than 1%.
Because the insurance is there as a safety net.
Exactly. You're willing to accept a lower cap because you've got that protection. And again, this matters even more in the lower middle market.
Where buyers are really sensitive to potential costs.
Exactly. Now, the article mentions something called a fraud carve-out.
Oh yeah, what's that all about?
Well, it basically says that even if there's a cap on liability, the seller can't hide behind it if they commit fraud.
So you can't just lie and get away with it.
Right. It's saying honest mistakes happen, but intentional deception is a different story.
Makes sense. Especially in the lower middle market where trust is everything.
Absolutely. But here's the thing. We're seeing sellers getting smarter about how they define fraud in the agreements.
Oh, so they're trying to make it harder to prove fraud.
Exactly. It's a real battle of the contracts.
Both sides trying to protect themselves.
And that's why having good legal advice is so important, especially in the lower middle market where those legal fees can add up.
A good lawyer can make all the difference.
Absolutely. Speaking of protection, what about escrow?
Yeah, that's the money set aside to cover potential claims after the deal, right?
Exactly. It's like a security deposit.
Makes sense.
And as you might guess, escrow amounts are different with and without RWI.
Okay, tell me more.
When there's no RWI, escrow is usually higher, maybe 5% to 10% of the purchase price.
But with RWI?
It can be much lower, maybe 1% or even less.
That RWI safety net makes everyone more comfortable.
Absolutely. What we're seeing is that RWI is really changing the M&A landscape.
Especially in the lower middle market.
It's not just a technical thing. It's a fundamental shift in how deals are done and how risk is managed.
That's a really important point.
It's changing how people negotiate, how deals are structured, and how risk is shared between buyers and sellers.
Wow, so RWI is something to watch closely.
Absolutely. It's going to be fascinating to see how it continues to shape the market.
Well, listener, we've covered a lot today. We talked about cautious optimism in the middle market, the strategic shift in private equity towards the lower middle market, and how RWI is impacting key deal terms. But before we wrap up, I think it's important to connect all this back to our listeners. All these deal terms and legal stuff.
Right.
It can sound kind of abstract.
Definitely.
But this has real-world implications, right?
Absolutely. This isn't just about understanding financial jargon.
Right.
It's about seeing the forces that are shaping the business world.
And that's especially true in the lower middle market.
Yeah, for sure. So what's the big takeaway here? What should our listeners in the lower middle market remember?
Yeah, what's the message you want them to walk away with?
Well, I think the key point is that the lower middle market is getting a lot of attention.
Oh, yeah.
Yeah, private equity firms see the value there, and that creates opportunity.
I think.
But it also means things are getting more complex.
In what way?
Buyers are more sophisticated, deal terms are evolving, and risk is being handled differently.
So the more you know.
The better.
Right. Knowledge is power.
Exactly. The more you understand these trends, the better you can navigate this changing landscape.
Whether you're buying, selling, or just trying to stay ahead of the game.
Absolutely. And don't be afraid to ask questions.
Right. Get some advice. Do your research.
Make sure you really understand how these trends affect you.
Because even though the economy might feel a little shaky,
Yeah, it's a bit uncertain.
there's definitely some optimism in the lower middle market.
Absolutely.
So those who can adapt and strategize.
They'll be the ones who succeed.
I like that. So to all our listeners out there, whether you're a seasoned entrepreneur,
We're just getting started.
stay curious, stay informed, and remember the power of a well-structured deal.
That's great advice.
And that's it for today's deep dive. Until next time.
Happy deal making, everyone.